Good morning, everybody. We're looking at double tax treaties, and this can be quite a tricky subject, and it is quite a technical session. Can you please raise your hand if you've ever had occasion to look at a double tax treaty or to read the provisions of a double tax treaty? Lots of hands. Excellent. That's advantageous. Double tax treaties aren't always that easy to read. When I read double tax treaties, sometimes I find things that just make no sense to me, and I'll share one example that's on one of the slides a bit later on. And if anybody can shed light on what this means, I'll be grateful. But I couldn't make any sense of it whatsoever. So double tax treaties, remember, aren't domestic law, they're international agreements. And one thing I'll be repeating as I go through is that double tax treaties aren't read in the same way that you would necessarily read, in the same way that you would read local domestic law. When you're reading domestic law, generally you're starting with a literal interpretation of what the law says, and then you might apply a purposive interpretation of that. In other words, you might try to work out what the law-making authorities had in mind when they introduced those rules, but you start with a literal interpretation. Double tax treaties are always purposive in their reading, so you always have to think about what they are intending to do, and that makes them quite strong in defeating avoidance arrangements, because you've got to go beyond the literality, if that word exists, the literal reading of the words. So what I'm going to be looking at in this is, first of all, we'll talk about what double tax treaties are for, why they might be advantageous to us as people giving advice to people on international structuring. I want to say a little bit about how we go about and look at some practical examples of how we go about interpreting a tax treaty and how we read different provisions. And I will be throwing up on the screen lots of examples from double tax treaties and be talking about how we would in practice, what we can actually infer from the reading of them, what the key words are, what the key points are, how you go about reading the provisions of a double tax treaty. We'll look at some key elements in double tax treaties that are relevant to us when we're trying to work out what the best structure is for any kind of international enterprise or any kind of international arrangements. There are different types of model treaties, and when governments are negotiating treaties, when two taxing authorities are negotiating between them about how they're going to operate and they're working out a treaty, they don't start with a blank sheet of paper. They start with a model treaty, and there are different model treaties, and that's why so many tax treaties look so similar, because they're all following a particular model. And finally, I will mention the interaction of double tax treaties and with BEPS and the multilateral instrument, and also we'll be touching on what the BEPS actions are in relation to double tax treaties, because several of the actions do link directly into the application of double tax treaties and allude to the fact that there should be an effort to make them more effective and make them less prone to any form of abuse. Oh look, lots of words. I'm afraid lots of these slides have a lot of words on, and I can only apologise for that, but hopefully as we go through this I'll be able to explain these a little bit. Now, what this slide is really telling you is that it is the local rules that you need to look at. Double tax treaties, you may have come across this before. What do double tax treaties not do? You see, you'll all remember that whatever it happens in your lives for the rest of your lives. You'll remember that bit from this course. Double tax treaties don't contain taxing provisions. They only contain relieving provisions. So it doesn't matter what a double tax treaty actually says. If it talks about a particular tax or a particular rate of tax, if that doesn't exist under the local law, it's irrelevant, isn't it? So you start with the local position. And this is sort of, there's a bit of a kind of misinterpretation that often goes on in our industry, because people use the phrase treaty shopping. And that can be appropriate, it can be right, that you are looking to put a structure in a particular jurisdiction because there is a particular treaty that limits the withholding tax that might be charged on a transaction from one jurisdiction to the other. But really what people are doing is jurisdiction shopping, aren't they? you're shopping around to find somewhere, you're putting your entity in a place that has a particularly low rate of tax or a particularly favourable set of incentives or a particularly favourable way of operating. That's what you're really doing. It's jurisdiction shopping rather than treaty shopping. The treaty is layered on top of that, and that enhances that relief or stops it being denied by something in the local law. But you start with the local rules. And getting the local rules right, understanding the local rules, isn't easy because there's lots of stuff out there on the internet that you can find, and lots of it is wrong. Most of it is a simplification, and some of it is out of date. So you always have to be very careful when you're looking at the local rules in any particular jurisdiction to make sure what you're looking at is the up-to-date rules, and and actually that what you're seeing is a proper explanation of them. The only way you can really do that, is to get local advice. So at some point when you're working on any assignment, you'll be getting somebody local to sign off on that advice. I've got one on my desk at the moment where somebody's received Swedish advice, and I've had to get a copy of that advice because this is presented to me as a really generic thing. Oh, there will be a tax charge in Sweden if we use a company rather than an individual as a member of this partnership. What does that actually mean? You look at the advice and it says something totally different. So getting local advice to determine what the rules are is very important. And this gives you a little bit of, when you get these slides, these links will help you with sources of information for getting an idea of what the local rules are about. So getting summaries of what local rules are about is relatively easy, and you can use these links for that. Finding a specialist who will be able to really tell you how they apply in those particular circumstances, then there is the worldwide directory that you have access to, and that link will be on the slides that will be coming out to you. Okay, what are treaties about? What are treaties for? Why do you have double tax treaties? Well, this is what this slide is talking about. The agreement's obviously between two, or can in some cases be more countries, but pretty much all double tax treaties are bilateral agreements. They're agreements between two countries. And they've got different purposes in mind. They're not just about making sure that there isn't any kind of abuse of the different tax rates between the two countries. They're not just about anti-avoidance. There are other things going on here. And when you think about it, when countries are signing up to double tax treaties, there's a sort of balancing act going on for them, isn't there? They want to encourage trade with the partner, with the country with whom they're signing the agreement. They want normal commercial activities to flow freely, you would imagine, between the two countries in question. But at the same time, they don't want to allow that in a way that can be abused, or they don't want to allow that in a way that could result in some hideous tax anomalies. So one thing that double tax treaties are about is to stop there being double taxation, because quite frequently there would be a situation where you have, in the case of a company which is resident in both jurisdictions, because the rules apply slightly differently, and we'll touch on that in a bit, and you could have scope for there being double taxation. So the first thing is that you want to basically avoid there being a double tax charge. So it's quite a positive thing. You want to make sure that that everybody's working on a level playing field. So there isn't something which means that one state's population is dealt with in a different way to the people living in the other state. So you want it to be a level playing field, and you want it to be something that encourages trade in a normal, unfettered manner. So it's kind of this thing about preventing discrimination between the taxpayers of the different states is actually a big part of what the treaties are about. So it's a level playing field for everybody, and also to make sure that people can operate with some degree of certainty. They know what's going to happen. They know if they're going to be trading with if they know if they're going to be selling the goods in the other state that's a signatory to the tax treaty. They know how the taxes are going to apply. So it's intended to provide some degree of certainty on that as well. And like I say, it's a balance, because it's not just all about making sure that there's a proper tax take in both countries. You may be giving a lot away in a double tax treaty, but that's actually to encourage people to do business with you in the right way. So I keep coming back to our colleagues at the back of the room from Holland. And the point there is that the Dutch double tax treaties are very generous, and it costs them a lot of money. It costs their exchequer an awful lot of money. But this does mean that a lot of companies set up in Holland as finance companies because there are tax advantages in doing that. So that's the quid pro quo. That's the trade-off for the Dutch tax authorities and the Dutch government, and that's the decision they can make. And that's what their double tax treaty is doing. So it is encouraging trade and investment, and that will be a motive in the minds of the people drafting tax treaties. And we touched on this as well in the BEPS actions, and it's an increasing feature of international tax agreements and the way the world works in fiscal matters. There will be provisions in most tax treaties that will allow for one country's taxing authorities to have access to information relating to residents of the other country and vice versa. And without that, it'd be very difficult to get information. And you wind back 20, 30 years, that used to be a big barrier to any cross-border taxation. The fact that you just couldn't find out about what somebody was doing in another state made it pretty much impossible for the local tax authority to raise the tax which it might otherwise think was due. Lots more words again. Treaties do override domestic law. So what you might have, it would start with domestic law, but then you have to apply the treaty on top of it, don't you? So, for example, domestic law might talk about there being a withholding tax on dividends of 30%. But then the country in question will agree a double tax treaty with somebody else, and it will say, in any transactions with that other state, under the double tax treaty, the withholding tax is limited to 5%, or the withholding tax is limited to 0%. It might be that they agree a double tax treaty with another state that says that the withholding tax on dividends is limited to 10%. That's what it might say in the double tax treaty. But they might not actually have a withholding tax at all on dividends. So actually that will only become relevant if ever they introduce a withholding tax on dividends. The treaty they've already entered into will stop that ever being more than 10% in respect of that particular country that they've signed that agreement with. So it's a combination of domestic law and the treaty law. The treaty overrides the domestic law in that respect, but you still start with the domestic law because the treaty isn't telling you what the tax charge is. It's just telling you what the maximum is on a withholding tax, for example, and it's telling you other things as well, as we'll see. There are other things, though, that affect how a double tax treaty works, and there are elements of international law that impinge on the functioning of a tax treaty. So, for example, you've got the EU Directive. You've got the EU Directive on interest and royalties, and that basically says that if you have members of the same group that are making payments of interest or making royalty payments to each other, then you don't have any withholding tax on that at all if they're within the same group, and if both companies in the same group are both situate, resident in states that are members of the EU. So you do get things that impinge upon the effectiveness of double tax treaties. Now, I can't think of an example where you've got something that tries to run counter to that. And if it did run counter to that, I'm not exactly sure what would happen. Well, I think I know what would happen. The European courts would say that the provision in the treaty was illegal because it was in breach of an existing international agreement, and they would try to stop that particular provision applying. And they've done that. We've seen that with certain domestic rules. We've seen that in the case of the UK with certain domestic rules, and equally that could apply to treaty provisions. Yeah? Making sense? Okay. There are different types of treaties that apply to different taxes, but we're really only talking about this one. You'll see if you go to any of the publications that list all the double tax treaties, you'll see there are ones purely on inheritance tax. You'll see there are ones purely on specific industry, things like transport. There are other ones that you see for oil and gas. And does everyone know about FATCA? Yeah, I'm not going to go into FATCA because it just makes me too depressed, because I regard this as US fiscal imperialism. So who's from the US here? So if I'm insulting you, then I apologise. But I know I've come across lots of people who are terrified by the potential application of FATCA because they actually never lost their citizenship of the US and suddenly find that they should have actually put in 10 years tax returns. I said I wasn't going to mention FATCA, and now I have, so I'm going to stop there, okay. But we won't be talking about that. And there are different types of tax treaties as well. This is the biggie. Because and we'll talk about the different models of tax treaty, and the one we'll be focusing on mainly is the OECD model, and you'll see that that covers all these different types of income and gains, and that's the one that we're almost always looking at and talking about. Oh my goody aunt, there's a good English expression for any for non-English speakers. That means oh dear. There are 3,000 double tax treaties worldwide, well more than that. And the vast majority are based on the OECD model. The way, like I said, that was first published in 1963. Importantly, nobody has to follow the OECD model. It's just a model, it's just a starting point for a tax treaty that you might want to negotiate with another country. But it's helpful because there's lots of commentary from the OECD about how that should be applied, and that does help with interpretation of the treaty. So you'd imagine that a safe bet for countries would be to use the OECD model, because not only is that kind of sort of tried and tested, you've also got an awful lot of commentary that you can refer to and you can rely on if there are any points of disagreement about the application of the treaty. And that commentary it does carry weight in court. It's not just commentary. It does have some weight. You can access all these different model treaties, and they're all slightly different. Like I said, the most common one, and the one we'll really be focusing on, and the one that comes up all the time, is the OECD model treaty. But ultimately, a treaty is, you can ignore, in a sense, what model it is. What model it's following is neither here nor there. You just get used to expecting certain things in it. So in the OECD model treaty, for example, paragraph 7 is always through business profits. Paragraph 13 is always through capital gains. So you kind of know where you're looking, and you just get used to that particular model. But ultimately, a treaty is just what it is. So it doesn't really matter what the model is. The UN Convention, we'll be talking about slight differences between the UN model and the OECD model. I won't be saying much about the US model convention because, as you've already determined, they've just depressed me too much with introducing FATCA. But the US one comes up less often anyway, so that won't be one that we'll be concentrating on in particular. I think I mentioned to you yesterday, the first job I had was working in the Treasury, and I used to, effectively, my ultimate boss was a guy called Norman Lamont, who was Financial Secretary to the Treasury. But my immediate boss was a guy called Eugene McGibbon, a wonderful guy, and he was what was called a permanent undersecretary in those days, as he was a very senior civil servant. And I remember one day he was telling us that his job used to be going and negotiating double tax treaties. And I remember thinking, wow, how cool a job is that? I negotiate double tax treaties. And I remember being incredibly impressed and just had no idea how you would go about negotiating double tax treaties. You turn up in the negotiating room and say, we demand all the tax you'll ever raise. I just had no idea what this was about. And actually, if I'd known this, I would have been a little less impressed. Because, of course, Eugene did not go to those meetings with, as I say, a blank sheet of paper and just demanding lots of different things that he wanted from the French government in relation to tax transactions going on between France and the UK. No, far from it. They turned up with the model treaty, and then they tinkered about the rate of withholding tax that would apply in that double tax treaty on those transactions. So a slightly less impressive job. Pretty great statement anyway. I wish I could say that when I turned up at a party. What do you do for a living? I negotiate double tax treaties. International man of mystery. These are great handles, aren't they? But the point is that anybody negotiating a double tax treaty does start. They have a big head start. They have these models that they start from, and really most of it is to do with tinkering with the particular rates and so on that will apply, and then occasional things that are relevant to that particular jurisdiction, maybe a particular type of industry or activity, maybe a particular point to do with the definition of residence, maybe a particular exemption from permanent establishments. Those kind of things are the things that then get put into the double tax treaty. When you are looking at a double tax treaty, this is quite an important point, because it'd be quite easy to look at the wrong thing. You might look at an old double tax treaty, you might look at the wrong double tax treaty, and you might look at one that isn't in force yet. And this is the first thing you should do when you're looking at the double tax treaty. This is what the information will tell you. It will tell you that it was concluded or signed on a particular date. It will then tell you that it entered into force on a particular date, and it will then tell you, by the way, forgive me, my 2017 being over there, I don't know why it jumped to the left. It will then tell you that it is effective from a particular date. Can anybody tell me what the difference is between that and that? Why is there one date when it's entered into force and one date when it's effective? Does anybody know?
Effective when it starts to apply.
Yeah.
So it's just given a time, yes, for the local jurisdiction just to be aware, to get prepared for this.
Yeah. Effective is the one you're looking for, really. That's when it actually applies to something. Entered into force means it is in law. And it will become effective from a particular date. So if you like, there's no turning back, and it's a bit like the legislative process in the UK, where you have the budget, and the Chancellor stands up and announces what's happening in the budget. This is changing, that's changing, this rate's going up, that rate's going down, and everyone goes off and goes, "Wow, isn't it amazing that he's done all these things?" And then if they're technically minded or tax minded, they then go to legislation and think, "Well, where is it?" And of course, it isn't anywhere yet because it has to go through a parliamentary process. So actually, under the UK legislative process, those dates tend to be the other way around. It tends to be effective from a date in March, and it tends to enter into force from a later date. And what that means is entering into force means it has been ratified by whatever legislative process the country adopts. Effective means that's when it's going to apply those particular rates to those transactions. And with double tax treaties, it tends to be that way around. Okay? Makes sense? Good. Great. Yeah. We'll start talking through a couple of treaties, and we'll start talking through what treaties look like over the next few slides. So like I said, most of them are based on the OECD model. They all look incredibly similar though. When you go through double tax treaties, they all seem to follow a very similar format. And like I said, that isn't coincidental. That is because they are all based on a particular on particular models, be it the OECD model, be it the UN model, usually the OECD model, as you say. And there's the link, by the way, in the slides that are coming out to you that you can use to access the OECD, the commentary on the OECD model treaty, which is it can be quite useful if you're ever in any doubt about certain provisions of a double tax treaty. And the way the treaties break down is like this. You have them in distinct parts, and part one is really to do with definitions, scope, things like residence, how you determine whether somebody's a resident of one member state or another member state in broad terms. It will ultimately defer to the local rules on that, but it might make reference to how those local rules work. And then there'd normally be a tiebreaker test if you're resident in both countries, which is really what the double tax treaty is interested in. So the double tax treaty will say something like, this applies to anyone who is a resident of either contracting state. By the way, for those who aren't familiar, the term contracting state is the phrase we use for any signatory to a double tax treaty. So it will say this applies to anyone who's a member of either contracting state, and it will say if you happen to be a resident of both contracting states, then there'll be a tiebreaker clause, and for the purpose of this treaty, you'll be regarded as resident possibly in both states, and it'll apply that way, possibly in the state where, and then there'll be a particular definition of what's going to tip the balance in favour of one state or another. The second part is the sort of meat of it, really. This is the section, as we'll see when we look into this in detail, that has all the different paragraphs, all the different clauses that deal with different types of income and gains. And if you look at a lot of double tax treaties, as I say, you'll start to notice the pattern. You'll start to know exactly where to look for a particular type of income or a particular type of transaction that's going on. And part 3 is to do with overriding provisions that, for example, intended not to be any kind of double taxation, overriding provisions that are intended to make sure that information is shared between the two contracting states. Normally sets out a mechanism for resolving any disputes between the member states in the event that they're both saying they should tax one particular type of income, and normally contains some provisions allowing for the proper flow of information and for information to be provided between the taxing authorities in both member states. That's the usual sort of format that you can expect to see. I'm afraid these slides are very busy. You have to forgive me, but this one's not. Please do not read all of that. But this is the contents of the standard income and capital double tax treaty, income and capital gains double tax treaty, and you can see there you go. Chapter 1, Part 1 is dealing with the scope of the convention and definitions. So that's Chapter 1 and Chapter 2. So the first part really. Then you get on to Chapter 3, and that's looking at all these things: business profits. There's always a shipping and air transport bit, dividends, interest, royalties, capital gains. You get the idea. And there'll be something there. There's normally, like I say, artistes, I love that word, artistes, entertainers, sports people, special rules that usually apply to them. So you'll get used to that kind of content, that kind of set of contents for a double tax treaty, because it's pretty much the same with all of them. And what we can do is we will look at some key articles on this. And so what we're going to look at is we're going to look at the definitions of persons covered, the taxes covered, and some general definitions. We're going to do that first, because this part of the presentation really is drilling down into what tax treaties look like and how specific provisions within tax treaties work. So that's what we'll be doing over the next couple of slides. Okay. I've probably already mentioned this, but the tax treaty starts with who it applies to, which is logical enough. And basically, it's residents of one or both of the contracting states. And under the domestic rules, it's quite possible for somebody to be a resident of both contracting states. Let's take a company that is registered in the UK, that automatically makes it UK resident, but is managed and controlled in the Netherlands. That automatically will make it Dutch resident as well. So it's quite easy to have an entity that is resident in both states. The double tax treaty will of course apply to that entity. It would apply to the entity if it were only resident in one state. Then the treaty goes on to Article 2 to look at which taxes are covered by the agreement. And like I say, it will be different in between treaties. So it may be that one treaty doesn't cover income from employment or something like that, and it's outside the scope of the treaty. You do get some omissions and some things deleted from specific treaties from the usual model. But like I say, that most of these things will normally, if not all of them, will be in most double tax treaties. And then the third article contains all the definitions that we need to rely on, or lots of definitions that we need to rely on for this purpose. Note that the word person is used for most double tax treaties, and person internationally is recognised as meaning not just individuals, we're all persons, but it means a legal person. So a person also includes a company. It also can include the trustees of a trust. It could include a partnership or a limited liability partnership. It can include a foundation. It can include lots of things. Everyone familiar with that when we're talking about persons, yeah? I'm always quite amazed at how many people I come across in our industry that don't actually appreciate that. I had some relatively senior persons say to me not that long ago, that provision only applies where it says you've got a person has to make the disposal, therefore that's an individual. And I was slightly shocked, but some people don't actually pick up on that. Person is nothing to do with individuals. It includes an individual, but it's not an individual. I'm going to focus on a couple of others now. Talk about what is a resident. Talk about under a normal double tax treaty, what is a permanent establishment. And we'll look at these things as well: dividend, interest and royalties. Why are we looking at dividends, interest and royalties? Why is that of any interest to us? Anybody remember yesterday? As you'll recall, all the opportunities that we're getting from structuring things and double tax across border, not all the opportunities, loads of the opportunities come from the differing withholding tax rates and the extent to which withholding tax rates can be limited under double tax treaties on payments for interest, dividends and royalties. So it's absolutely central to the stuff that we do. Okay, let's look at the meaning of resident. It means, right, note, the term resident of a contracting state means any person who, under the laws of that state, is liable to tax therein. Again, I may have mentioned this, tax treaties don't tax you, they only relieve you, and similarly, they lean on all the legislation of the local country. They're bound to. Why would they do anything else? They don't have to go into a big definition about what a resident is. They just say, we go on the laws of that state. What's the only problem with saying the laws of that state? How many states have we got?
2.
Thank you. And see, never difficult questions on my presentations, always easy ones, but just check you're listening. Okay, so we've got 2 states. What's the problem with saying it depends on the laws of that state?
We don't know the laws of each state.
We don't know the laws of each state, and what might the laws of each state, what frequently are the laws of each state? Exactly, there may be different laws. So what you're saying is, when we're talking about resident, then that can be somebody who is resident under the laws of that state. Absolutely fine, except you'll then find a whole load of people are resident in both jurisdictions, and for that reason, for different taxes, you need to work out a tiebreaker. And there will be different ways in which that tiebreaker is determined depending on different taxes. So it's an obvious point, but just wanted to make that. And here we have it. Where by reason of the provisions of paragraph 1, a person other than an individual, what's a person other than an individual?
Companies.
A company, yeah, absolutely, and some other things. But principally a company, that's the main person that will be a person other than an individual, is resident of both contracting states, then it shall be deemed to resident only of the state in which its effective management and control is situated. So that's what we were talking about yesterday, about effective management and control. Effective management and control can be very important when you're deciding under a double tax treaty, where there is a double tax treaty, whose tax takes precedence, who wins the tug of love to tax that particular entity. That's really important in that context. Everyone see that? Yeah? Normally, effective management and control will make you resident of any state. The point is, where there's a double tax treaty, it might mean that for tax purposes, you're not resident in another state who's a signatory to the tax treaty. Note, by the way, there are 2 words which I'll be talking about in double tax treaties. Shall, and I can't find, and what's the other word I'm going to talk that contrasts with shall?
May.
Thank you, may, yeah. Double tax treaties will often say something shall happen, something shall be the case, which means end of story, we're not arguing about it, that's what's happening. It's not providing a tax charge, remember, but it is saying what the situation is. The other word that we'll see is may, and may means the participating country, the signatory to the tax treaty, has the right to do that. They don't have to. So where it says this may be taxed in the other contracting state, the other contracting state has the right to tax it under the double tax treaty. If they decide to tax it, they won't be in breach of the double tax treaty. They don't have to. That's back to their domestic law again. This is an important provision of all double tax treaties to look out for. And we'll be talking about the concept of permanent establishment in the session after the break. So the point about permanent establishment is that permanent establishment, and I'll spend a lot of time about what a permanent establishment is. A permanent establishment can give you a taxable presence in a country that you're doing business with. And as we'll see when we look at permanent establishment in detail, a permanent establishment is the difference between doing business with another country and doing business in another country. So there's one thing when you sell goods to somebody in another country, you're just doing business with them, aren't you? But depending on how you conduct that business, you might create a permanent establishment in that country. That means you're actually doing business in that country. And that gives you a taxable entity in that country. Even though you haven't created a company, even though you haven't created a partnership, even though you haven't created anything else that you think of as being a taxable entity, you might just by the fact of the way you're doing things, have created something that is a permanent establishment. And every double tax treaty talks about what a permanent establishment is. The OECD one and the UN one differ slightly on this, and they differ in one important way. And we will be talking about this more in more detail. But just note a couple of things. It's got to be a fixed place of business, through which the business of an enterprise is wholly or partly carried on. And it gives some examples. So, a question for you: if it's not in these examples, can it be a permanent establishment? If there's something else that isn't in that list, can it be a permanent establishment? Absolutely, yes, because it says includes especially. So this is not. A lawyer would add the words, but notwithstanding the generality of the foregoing, this doesn't override any other possible interpretation of permanent establishment. It just gives you a couple of clues. So it just tells you, oh, in particular, look out for this. So in other words, next week I'll be wearing lots of different colour shoes. I'll be wearing brown shoes, black shoes, green shoes, yellow shoes. Does that mean I won't be wearing red shoes? No, I might be. I'm not wearing any of those, but I only ever wear black shoes, by the way, but silly example therefore. The point is that doesn't exclude anything else. But look at the things that are definitely permanent establishments. A place of management, okay, a branch, okay, an office. That's a bit easier. An office you can think of because you can go and you can tap it, can't you? It's tangible, it's solid. You can see it actually exists. A factory, that's easy as well. You can see that. You can see that exists. These are nice, easy ones. A workshop, similar. You'll do well to miss a mine or an oil well, so that's probably quite good as well in terms of determining what is a permanent establishment. But there's several that are nebulous. There's several that aren't absolutely certain what they mean, and you have to think about what that could possibly be. And similarly, even this one, and this is where the OECD treaty differs from the UN treaty, by the way. The UN treaty talks about 6 months instead of 12 months. But a building site or construction or installation project constitutes a permanent establishment only if it lasts more than 12 months. That's the normal OECD meaning. So in other words, if you get somebody overseas working on a building project, so there's a building site there, if that building site is at your disposal, we'll come on to that in the next session, then that can be a permanent establishment only if it lasts 12 months. That's a harder question than you might think. When's a building site start? And when's it end? Well, I live in Leicester. There's been hoardings up outside this levelled bit of ground for about 2 years. I've not seen a bulldozer on it at all. I happen to know they're building a hotel there, but I only know that through a contact of a contact. So has that started? Don't know. When they actually do the building project, when's it end? Well, there is guidance on that. We'll be talking about all of that in a bit. But every double tax treaty, I think, contains something defining what a permanent establishment is. Remember, it's only adding to your possible interpretation of what it can be. It doesn't limit it. Just a couple of words you can pick up on here, though, to help in your understanding of what a permanent establishment may be. Well, actually, sorry. Here we're talking, on this particular slide, what we're talking about is actually the exemptions from being a permanent establishment. And this is actually quite useful. This is where the double tax treaty is being quite helpful, because there are certain things that can't be a permanent establishment, and the things that fall within these exemptions. But just pick up on a couple of words for these exemptions that appear in the double tax treaty. And remember, double tax treaties don't tax, they only exempt, but how far does that exemption go? So we're not on about them imposing a tax charge here, but we're on about them not necessarily giving us the exemption that we might want, and that depends upon how we interpret this. It says that permanent establishment shall be deemed not to include, okay, the use of facilities for the purposes of storage, display or delivery of goods or merchandise belonging to the enterprise. So if you've got a company in the UK and it has a facility in Saudi, let's say, where people can come along and have a look at the goods that are for sale, but it is just a storage, it's just a display facility. That might not be a permanent establishment, might not, I stress. The maintenance of a stock of goods or merchandise belonging to the enterprise solely for the purposes of storage, display or delivery. So it might not only be display, it might be that you're warehousing them just to send on to customers. So that might not create a permanent establishment. But there's actually normally an extra requirement in this, and we'll be talking about this after the break. There's normally an extra requirement that those activities aren't the core of what you do. So they've got to be ancillary to the main business of what you do. So if you're a manufacturer and you've got a storage facility over it, so you're a UK manufacturer, you've got a storage facility over in Saudi, then and that's just so you can store your goods for distribution in Saudi, that probably isn't a permanent establishment. If, however, you are a warehouse business and you set up a warehouse in Saudi, that is a permanent establishment because that is not ancillary to your business, it is your business. These activities have got to be of an ancillary or preparatory nature in order for these exemptions to actually apply. And that's quite easy to miss. And this is an important exemption. We'll be touching on examples of this when we go through some of the planning that's available to us this afternoon. And I may refer later on to a commissionaire arrangement, and I'll be talking about things like limited risk distributors. And this is what this exemption is relevant to all of those. An enterprise shall not be deemed to have a permanent establishment in a contracting state merely because it carries on a business in that state through a broker, general commission agent, or any other agent of an independent status. How do you reckon it defines independent status? Really helpfully, like so much of tax legislation, it defines independent status. Somebody's independent if they are not dependent. Great. It's like loads of UK tax law. Activities are substantial if they are carried on to an extent that is not insubstantial. Thanks. And we wonder why we spend so much time in court. So there's not a particularly helpful thing there, and that is a very nebulous area when you have an agent. When you have somebody over there in the other jurisdiction who's running around doing stuff for you, maybe finding your customers, when are they dependent on the enterprise? So UK entity, let's say, with an agent over in Saudi, when is the Saudi agent dependent on the UK enterprise? Well, if they're an employee, probably yeah. But if they're not an employee, are they dependent? Depends on the it depends on the circumstances, depends on the actual facts of how things are run. Okay. Does that make some sense? We looked at PEs there, and we looked at what would be a PE under a tax treaty, and we talked about some of the exemptions for a PE, and we talked about how the tax treaty limits those exemptions. Okay, the actual definition of a PE is down to domestic law, as we know, but what will be a PE and what definitely will be a PE and definitely won't be a PE is to some extent governed by the provisions of the double tax treaty. Looking now at specific provisions in double tax treaty that deal with different forms of income and gains. We'll kick off with the business profits. I asked you to be aware of a couple of words in this, which is important. Profits from an enterprise of a contracting state shall be taxable only in that state. So profits of an enterprise of a contracting state shall be taxable only in that state. Great. Unless the enterprise carries on business in the other contracting state through a PE situated therein. If the enterprise carries on business as aforesaid, the profits that are attributable, important phrase, that are attributable to the permanent establishment in accordance with the provisions of paragraph 2 may be taxed in that other state. What determines whether or not they're taxed in that other state?
Local law?
Yeah, the local law. The point is, if the other jurisdiction where the PE is situated introduces a tax charge on the profits attributable to that permanent establishment, they are not in breach of the treaty. That's all that's saying, yeah? It doesn't say they have to, just says if they decide to, and they pretty almost always do. It just means that if they decide to, they're not in breach of the treaty, yeah? And it's important to spot the difference between shall and may when you're reading a double tax treaty. Maybe an obvious point to lots of you, but I have conversations with people where they've obviously missed that distinction. Again, down to what the domestic rules say. On this one now, there was an important point I was going to bring out here. Bear with me a second. this is making a statement that I would have thought was blindingly obvious to anybody, but it's just making it completely clear that the provision doesn't go further than it's intended to do. This is to do with the taxation of dividends, and it's telling you dividends paid by a company which is resident of a contracting state to a resident of the other contracting state may be taxed in that other contracting state. So in other words, they may be taxed in the contracting state. However, such dividends may also be taxed in the contracting state of which the company paying the dividends is a resident. So this is the provision that means that you can have a withholding tax on a dividend, but the recipient country where the dividend is received by a company in that country can also tax the receipt of that dividend. Very importantly, but if the beneficial owner of the dividends is a resident of the other contracting state, the tax so charged shall not exceed. This is your limitation on the withholding tax, isn't it? Okay, but what phrase did I just read out that's important there? Beneficial owner, yeah. Do you remember yesterday we were talking about beneficial ownership? And we were on about whether an arrangement could be attacked because an entity didn't really have beneficial ownership of the income it was receiving. This is why I was banging on about that so much. This limitation of the withholding tax to 5% of the gross dividend applies, yeah? Where you've got two countries that have signed up to this double tax treaty. Fantastic. And it applies if the beneficial owner of the dividends is a resident of the other contracting state. So think back to our example where we were putting in place a conduit company. If somebody can demonstrate that conduit company wasn't the beneficial owner of that income, this doesn't apply, does it? This only applies where it is the beneficial owner. So you can see why beneficial ownership is important. It's not just a kind of general worry about how a country might apply an anti-avoidance rule. It's in the double tax treaty. And when you waive the double tax treaty at your local taxing authority and say, guys, we only deducted 5% withholding tax, this is why, they may reply, no good. There isn't somebody who is the beneficial owner of that dividend under this who's a signatory to this tax treaty. The beneficial owner is the company right at the top, and they're not in a jurisdiction that's a signatory to this tax treaty. There may be a signatory to another tax treaty, in which case fine. But actually not fine, is it? Because remember in the examples we looked at, from USA to Saudi, big withholding tax. From USA to Netherlands to Saudi, very low withholding tax. But only if somebody in the Netherlands is the beneficial owner of that interest. Right, who thinks they're confident about reading double tax treaties now? Should we have a go at trying to work out what paragraph 4 means? Yeah, let's do that. It's nice and early in the morning, everyone was out drinking last night, so this will be a bit of fun, won't it? So I'll just read it out. The provisions of paragraph 1 and 2 shall not apply if the beneficial owner of the dividends, being a resident of a contracting state, carries on a business in the other contracting state, of which the company paying the dividends is a resident through a permanent establishment situated therein, and the holding in respect of which the dividends are paid is effectively connected with such permanent establishment. In such case, the provisions of Article 7 shall apply. Everybody clear? Okay. Is that difficult to read? Is that confusing? Is anyone confused? Yeah? Good. Right, you should be. Double tax treaties aren't easy to read. This is a quick illustration of how you can read them. I think I know what it means, by the way. I think I know what it means. Might be wrong. Oops. There's my multicoloured flip chart. Oh, there's another multicoloured flip chart. There's a blank piece of paper. Okay, so how do you go about reading this? How do you go about working out what the hell that means? By the way, I picked one that just at random, so this isn't going to be of particular practical use, but this is just as an academic exercise, really, in how you go about reading it. Well, what you have to do when you're reading double tax treaties, I tend to find, is this is talking about the dividend provisions, by the way. So it's talking about how the dividend provision will apply. Shall I give you a spoiler alert? Okay, spoiler alert is what this is actually saying is, in certain circumstances, this isn't treated under the dividend provision at all. It's treated under Article 7. What's Article 7? Business profits, yeah. So in other words, we're not going to apply any of the dividend provisions of this. We're going to apply Article 7. If we're within this, and we're within this, the provisions of paragraph 1 and 2 shall apply if the beneficial owner of the dividends. So, okay, we've got this. Oh, blimey, I've gone very weak overnight. That's the border, okay? So who's the beneficial owner of the dividends in this instance? We've got lots of profit down here. Make it dollars. And we're paying a dividend. Who do we think is the beneficial owner of the dividends in this particular instance? Provisions of 1 and 2 shall not apply if the beneficial owner of the dividends. So who's the beneficial owner of the dividends? I'll give you some names. There's A and there's B. Who's the beneficial owner of the dividend? A, absolutely, because we're going to pay a dividend from there to there, aren't we? So that's where you start. The beneficial owner of the dividends. Okay, so we're talking about A. If the beneficial owner of the dividends, being a resident of a contracting state, that's one state. That's another state. And this slide is a right state, as most of my slides are, but never mind. Okay, so you've got a resident of a state there, okay, that is the beneficial owner of the dividend. Everyone happy with that? Yeah? Okay. Carries on a business in the other contracting state. So we're talking about A. Where does it have to carry on where does it have to carry on the state 1, state 2? Where does it have to carry on the business? Don't think so. I've confused you by putting state 2 at the top and state 1 at the bottom. Let's try it again. The provisions of paragraph 1 and 2 shall not apply if the beneficial owner of the dividends, being a resident of a contracting state, that's a resident of state 2, okay, carries on a business in the other contracting state. So where do we think that is? State 1. I'm sorry if that's what somebody said, I do apologise. It's me getting confused, not you. Okay, so it's got to be carrying on a business in state 1. Everyone agree with that? Okay, so A has got to be carrying on a business . So it's got to be like that, hasn't it? Yeah? Everyone see that? Okay. It's got to be carrying on a business. Where are we? It's got of which is contact to say which company. Oh, hang on, carries on a business in the other contracting state. That's right. So it carries on a business in the other contracting state, of which the company paying the dividends is a resident. Everyone see that? That company paying the dividends is a resident in state 1. Okay. Through a PE situated therein. So that's got to be a PE. Everyone agree with that? That's got to be a permanent establishment, okay? And the holding in respect to which the dividends are paid is effectively connected with such permanent establishment. So what needs to be connected with the permanent establishment? B, I think that's right. Yeah, because it's in respect to it's and the holding in respect of which the dividends are paid, the holding, that's the holding, in respect to which the dividends are paid, is effectively connected with such permanent establishment. Everyone agree with that? So that has got to be connected with that. Does everyone think I've got that right? Yeah. Oh, blimey. Oh my God, I've broken it. I'm plagued by equipment failure on this tour. So that's got to be connected with that. Yeah? That's what that says. And if it is connected with that, there isn't a dividend at all. It's just a business profit. And can you see what they're getting at? They're basically trying to say, look, if this all is just really one business, and there isn't really a dividend being paid here at all, you're just going on a business there through a permanent establishment, then you're just going to be taxed under Article 7, which is through business profits. And that might be because the withholding tax position in respect to business profits is less favourable than the dividend one. So it's stopping you doing something a bit naughty, isn't it? It's stopping you carrying on a business through a permanent establishment and just maybe setting up a shell company, this shell company charging this a management fee of some description, then paying a dividend. That's what it's stopping you doing. Does that make sense? The reason I've gone through that is because the reading double tax treaties, reading legislation isn't easy. It's something where you have to kind of stop and think about what it is that you're trying to do, and it can be very confusing because so I got confused there because it talks about the contracting state, the other state. So you always have to stop, and I find drawing it out like that is actually quite a good way of doing it. Yeah, great. Okay. Why is all this significant? lots of things that are significant for this because we looked at this before. Remember that the example that we were looking at yesterday, we reduced on a dividend that was going up from the USA to the Dutch company to the Saudi company. We reduced the effective rate of tax from 66 to 53. But in order to do that, we were relying on that with a reduced rate of withholding tax. Which is a 5% rate of withholding tax. A 30% rate would apply there, which gave us our 66% effective rate of tax. Remember that if we're not within the provisions that I've been talking about in the double tax treaty, in particular the one I'm underlining is the beneficial ownership one, then that is irrelevant, isn't it? Because if that company isn't the beneficial owner of those dividends and that company is the beneficial owner of those dividends, then that's happening under the double tax treaty, and it's the US-Saudi double tax treaty that's a relevant one. Yeah? Simple. Okay, just looking at interest, and it's similar points again that I want to emphasise. Interest in a contracting state and paid to residents, the other contracting state may be taxed in that other state. Again, however, such interest may also be taxed in the contracting state in which it arises and according to the laws of that state, but if the beneficial owner of the interest is a resident of the other contracting state, the tax surcharge shall not exceed. Again, you've got the limitation of what the withholding tax can be in the state from which the interest is paid, but that is limited only if it's paid to somebody who's the beneficial owner, only if somebody becomes the beneficial owner of that interest, and if the person becoming the beneficial owner of that interest is a resident of the other contracting state. Same point that we were talking about before. I won't say anything extra about that because we're running a little bit short on time. And again, the significance of that, well, it's obvious. We've talked about how advantageous this treasury company may be. That 0% withholding tax is based on the tax treaty between which two countries? Exactly, the USA and the Netherlands, okay? That 0% withholding tax is based on which double tax treaty? Exactly. So Holland, the Netherlands, and Saudi Arabia. Okay. Nothing in this diagram applies to that. But if that company is the beneficial owner of the interest, then that's the only double tax treaty you should be looking at, isn't it? So that's why the beneficial ownership point again is referred to in all double tax treaties, and that's why it's so significant. Okay. How often am I going to repeat this? Probably the last time, actually. I can't remember it coming up again. So for the last time, I'll mention beneficial ownership because, again, in the definition of royalties, it appears. One thing that's worthwhile noting is that under Article 12 of pretty much every double tax treaty, you will have a definition of royalties, which is worthwhile bearing in mind. So payments of any kind received as consideration for the use of or the right to use. You notice there that it's stopping a little bit of if you get a payment and you don't actually happen to use those particular rights that you've paid for, you're still not outside the provisions of the treaty. Very kind. Any copyright of literary, artistic or scientific work, film rights, patent rights, trademarks, design or model plans, secret formula, or process or for information concerning industrial, commercial or scientific experience. It covers most things you could probably imagine that you could imagine royalties applying to. So pretty much it's any kind of intellectual property or any kind of intangible property. We did mention yesterday that royalties can also apply to use of natural resources. So you can have a royalty for the use of a natural resource. No mention of that there, so I don't think there is. So basically, it wouldn't extend to that. But this limitation of the withholding tax applies to anything that falls within that definition of royalty, not a potentially wider legal definition of royalty. So just be aware that there is a separate definition of royalties in the double tax treaty. In practice, again, you end up with the same result that we talked about for the interest payment example that we ran through yesterday, so I'm not going to run through this in detail because it's something you're familiar with. But remember that again, we are relying on the limitation of the withholding tax rate in the treaty between that country, and we're relying on the limitation of the withholding tax between Holland and Saudi Arabia. At that point, we don't have a limitation of a withholding tax, or not as generous a one, between the USA and Saudi. So again, the beneficial right, the beneficial ownership of that royalty payment has to be there in some form or another. If it's not, and the beneficial ownership is up there, you haven't achieved anything by that structure. And just be aware that if it is a royalty payment, almost certainly fine in any circumstances, but it's got to fall within that definition of royalty payment in Article 12, hasn't it? So if actually, as I told you yesterday, that a royalty payment can be a payment for the use of natural resources, well, there was no mention of that in Article 12 of that double tax treaty to be looked at. And if there's no mention of that in that double tax treaty, but there is in that double tax treaty, and it is a payment for the use of natural resources, then you won't get a limitation there, you will get a limitation there. So you just got to be aware of those nuances and those details when looking at that. And I think it's quite important not to assume on those things. The definition of royalties is a good example. It'd be really easy. Once people start using the word royalties, you think, we got royalties. Well, have you? And it's all to do with the words. Everything we do is to do with the words in legislation or in tax treaties. Yeah. And although tax treaties are read purposively, although you try to get behind the mind of the person writing it, that doesn't mean you can think, well, come on, they said royalties. They mean any royalties. They don't just mean those that they said. There's no doubt about the purpose in the mind of the person writing it. They meant those things because they defined them. That's your best evidence of anything. So that wouldn't get you off the hook if you happen to have a royalty that fell outside that definition. Okay. I won't say much about the UN model because we're going to fall short of time, but there are a couple of differences. The building site thing is 6 months rather than 12 months, so it's much easier for a building site to fall within definition of a PE. And you do also have a provision in the UN model for the provision of where services are provided into another jurisdiction. Very difficult normally to create a PE where all you do as a business is provide services into another jurisdiction. There isn't anything specifically to create the PE unless you set up an office there and thereby create a permanent establishment. There isn't really anything that does it. There is under the UN model treaty. So the furnishing of services, including consultative services by an enterprise to employees or personnel engaged by the enterprise for such purpose. That's quite a broad term, isn't it? Engaged by the enterprise for such purposes. So somebody who's a broker or a commissionaire, somebody who's just on a consultancy fee, they would be, you'd imagine, engaged by the enterprise for such purposes. But only if activities of that nature continue within a contracting state for a period aggregating 183 days in the 12-month period. So you've got to be doing that for half the year. So under the UN treaty, a commissionaire arrangement, which I'll be talking about later, wouldn't necessarily work to stop you having a permanent establishment. That does have a provision that creates a permanent establishment where services are provided. And there's a difference as well between the recommended, remember recommended tax rates? My old boss, Eugene McGivern, could negotiate whatever number he wanted on that. There you go. That was one thing he genuinely did. He didn't start with a blank sheet of paper, but he started with a model, but it had a recommended maximum rate of withholding tax. And the OECD model is different from the UN model in that respect. This is a clause that you may find in double tax treaties, and I call this the Best Mates clause, where you've got two countries that love each other so much that they want their tax treaty to be really special, and they want it to be the best ever. So you can include a provision in a tax treaty which means that the country you've concluded that tax treaty with has a favoured status compared to any other tax treaty. Just don't tell the other nations of the world that we've got it, okay? Otherwise they'll get jealous. But you can include a provision in the tax treaty that it means that whatever superbly low rate of withholding tax you have offered to this other state, let's say you've said you'll never charge more than 10% on dividends. If you happen to agree a treaty with a third state where you apply a rate of 5% withholding tax on dividends, it automatically figures in this. So this is read through to substitute your best deal, whoever you've done that with, for what you've actually got in the treaty. That's called a most favoured nation, or MFN clause. Everyone get that? Yeah. I can't think of examples of that, but just do keep a looking out for that. I've mentioned this, that that tax treaties are governed by international law, and how do you actually interpret a tax treaty? How do you actually apply a tax treaty? What do you do if people disagree about the application of a tax treaty? These are complex issues, because when you're getting into international law, it's not like in the UK, where the UK disagree with an interpretation we're putting on somebody's tax affairs. We have a process they can go through and penalties they can easily raise. Way different where you have difficulties in international law. There are only so many things that can happen, and usually remedies are found by agreements between the participating states. But I mean, ultimately, in theory, you go to war, don't you? If you really disagree about the provision of a double tax treaty. Not seen that yet, mercifully. But how do you actually resolve disputes? Well, it's down to the normal way in which you resolve international disputes. But just bear in mind that in interpreting treaties, in applying them, courts, if you go to an international court, so if you went to the European Court, for example, to get a point resolved between two EU member states, there are international treaties that will be influential in determining how you read the treaty, and, as I've said already, you do read the treaty on a purposive basis. You don't read it literally. So if you think you've come up with something really clever because it uses a particular bit of terminology and you go, aha, that can't apply to X, Y, Z, that's clever, isn't it? That won't work. If it's obvious that they meant that it should have applied to X, Y, Z, if everyone can see that, if it's just common sense, they just forgot to mention it, or they just weren't specific about it, or they just got the wording a little wrong, that won't help you in the case of a double tax treaty. It probably won't help you under much domestic law nowadays, because courts are moving that way anyway, and tax law is about the only place where courts frequently still don't take a purposive interpretation. Do you know what I'm on about when I say a purposive interpretation? Have I explained that properly? Possibly not. The words of legislation say a particular thing, and you can read it literally. If they produce a bizarre result, you can wonder whether anybody actually intended that to be the result, and that's a purposive interpretation. And if it's just that you think, well, they wrote it that way, we can see what they were getting at, it actually produced this weird result, that can't be right. Courts still in the UK will take a literal interpretation if the literal words are clear enough. So your bizarre result still stands. That wouldn't be the case under double tax treaties. You'd have to read them more loosely, more broadly. Okay, just looking at double tax treaties for Saudi, just very quickly, they've got lots and they've negotiated double tax treaties with all these countries. Could everyone just have a read of that slide for a few minutes? No, we couldn't, thank you very much. That's included for reference only. But when you get details about the withholding taxes that any particular country has with another country, or with other countries, when you're trying to find them out, you'll find a table like this that lists all the different countries and the withholding taxes that apply on payments of dividend and interest to those other countries. And just be aware that you always have that little table at the bottom, all those asterisks which caveat the special circumstances in which special rates of withholding tax will apply to certain industries or in certain circumstances. That's what you need to read to determine as a guide to what the rate of withholding tax is applicable in any particular country. And then to be absolutely sure, you need to go to the double tax treaty to make sure it works that way. I mentioned that that it's a balancing act. When countries enter into double tax agreements, you're trying to get something that commercially works. It's not just about tax. You're trying to make the world work. You're trying to make your economy work in a particular way. And you're trying to get certain economic activity happening. But it can be expensive, and we're using the Netherlands again, because the Netherlands does, as we've seen, forego a lot of tax that it could otherwise collect, doesn't it, on payments that are made to it and out of Dutch resident entities in order to encourage people to use the Netherlands as a kind of finance hub. So that's something the Netherlands wants to do. This is what it's costing it. with these different partners. This is because of the double tax treaties it has entered into with these different trading partners, and it's expensive. So you'd imagine the Dutch Treasury have sat down and worked out that they can afford to lose that much potential tax on the basis that the additional revenue that they're getting by the influx of inward investment outweighs it. That will be the decision they'll have come to. And that's absolutely fine, but you are seeing double tax treaties being cancelled now because of fears about avoidance. And that's why one of the actions is the prevention of treaty abuse. So one of the BEPS actions is to do with the prevention of treaty abuse. And there are lots of ways in which the BEPS initiative is suggesting that treaties can be changed in order to minimise the risk of treaty abuse. And I'll just run through these very quickly, because the main things are anti-abuse provisions, okay, that could actually take the form of limitation of benefit or principal purpose test. And I'll talk about what these are. But it's also suggesting in the BEPS actions that there should be a sort of catch-all in the preamble to any double tax treaty. And it's basically saying, look, we're entering into this double tax treaty. In doing so, we do not want to create any opportunities for people to avoid tax or evade tax. And if it's operating in that way, then we'll agree between us that it ain't going to operate in that way, that we can actually say we do deduct tax at that particular point where it otherwise wouldn't be deducted. That's the idea of that catch-all. I won't go through, I'll just get straight to the point. These are the examples we looked at before, where you've got an interest payment going from a company A all the way to company C, and it's going via Luxembourg. You'll be familiar with this, won't you? It's going via Luxembourg, and we don't have any withholding tax because of the double tax treaties. Where that's an abuse of the intention of the double tax treaties, the catch-all would be intended to stop that, or one of the provisions that we've got by reference to limitation of benefit, which I'll talk about in a second, or principal purpose test, might also stop that. I've said it 100 times. What might also stop that being effective? What might company be not? What might the Luxembourg company? Thank you. It might not be the if that isn't the beneficial owner of the income, then it might not work anyway. But remember, the point is these extra provisions are intended to apply even where you've thought of the point about beneficial ownership, and you've made sure they kept the money for a bit, and you made sure they invested it and put it to some extent at risk. Even when you've done that, and you can demonstrate that company was the beneficial ownership of that money, even then, the extra provisions which the BEPS action is suggesting are incorporated into double tax treaties can mean that you don't get the benefit of that. And the effect is massive, isn't it? By the way, the effect, if they start using these and using these kind of anti-avoidance provisions in the way that they could apply them, and they go back some way, which different tax authorities will have the opportunity to do that. So in our example here, the UK tax authorities could lean on a provision, on a new provision in a double tax treaty with Luxembourg to say, look, this is being exploited in this way, and they could go back 6 years under UK law. You could get something like this happening. You're getting 3 million quid going in interest, and we weren't having any withholding tax. So turns out now we should have had withholding tax, because that fails on the general anti-abuse rule that's going to be included in the double tax treaty. So really, we had an interest payment up there, and we should have had a withholding tax charge on that. And if that's the case, the consequences are painful. We get that sort of charge multiplied by 6 years, 4.5 million quid. And you probably will see over the coming years companies that have entered into arrangements like that being challenged under general anti-abuse provisions. You could have that challenged under the domestic UK general anti-abuse rule. The BEPS intention is that double tax treaties include a similar rule, or a principal purpose test, or a limitation of benefits rule, which I'll tell you about in a sec, or all of them, to mean that you don't get those benefits in the way that you thought you might. How are we doing? Actually, doing slightly better for time than I thought. The limit. I didn't say anything about the limitation of benefits rule. I think I covered that in a different session actually, but I'll mention it now. A couple of things I mentioned there for how tax treaties might be amended to make sure that they can't be abused is, first of all, I mentioned a general anti-abuse thing. Okay, so a general anti-abuse rule of some sort, or a general anti-avoidance rule. Absolutely fine. What's the problem? What do you think the problem is with the general anti-avoidance rule? Oh, definitely interpretation. What's the risk with interpretation of a general anti-avoidance rule? Remember, you've got to go to court and you've got to say, look, we're deciding we're going to charge that much tax. These guys set up this arrangement. They thought it worked. We're deciding we're going to charge that much tax based on the general anti-abuse rule. You've got to persuade a court that that's a valid way of doing that. What's the problem with the general anti-abuse rule? It is to do with interpretation, but it's specifically to a particular thing about the interpretation of a general anti-abuse rule. And the clue is in the first word. General, yeah, it's general. What's it on about? If I said to you, look, I'm introducing a rule today, okay, I'm presenting this course, well, I'm in charge here, yeah, I'm not fooling any of you, I know. And if I say, right, I'm introducing a, did I just cause somebody a headache by whacking my microphone then? Apologies if I did. If I said I'm going to introduce a rule, right, from now on, if there's stuff goes on here, everybody pays 20 quid as a fine, okay? Everyone clear? If the stuff goes on here, and I say the stuff goes on here, I want 20 quid off everybody. What's the problem with that? Apart from that, I have absolutely no right to do that whatsoever. What's the problem with that?
No definition of what stuff.
Yeah, what am I about? What's stuff? What stuff? What are you talking about? Well, you know, stuff. You know, I don't know, people talking. I don't know, whatever, stuff. If stuff goes on, you all pay me 20 quid, right? And the point is, it's too general, isn't it? How can you could legitimately say, well, don't be ridiculous. I didn't know you meant that. I didn't know you meant that if I got up to go to the loo, that was that was covered by that. I didn't know you meant that if I dropped my pen on the floor and picked it up. I didn't know you meant that if I whatever. And that's the whole point. Laws, what are laws for? It's a rule of law. Rule of law means you draw a line and you're either one side or the other side, and you conduct your affairs in life in the knowledge of that. If it's so general that it just means you get on with your life and we'll decide if we're going to do this to you one day, that the world falls apart. If you all went home, if they introduced a rule tomorrow that said, right, there's going to be a speed limit on the roads, but we're not going to tell you what it is. And then at the end of every year, we're going to ring you up and going to say, well, we've been following you around, and do you know you broke the 5 mile an hour speed limit? Oh yeah, we proposed that in August. That applied for the whole of August, and you owe us £1 million in fines. Why doesn't that work? Well, you can't live your life. If it's so vague, if laws are so vague, so uncertain, you don't know how they're going to apply, they're ineffective, and the courts will generally take that view. So that's the problem with the general anti-abuse rule. What do you mean by avoidance? What do you mean by even evasion? Evasion's a bit clearer, but how do you apply it? So the general anti-abuse rule is only likely to be so effective because the chances are, when a court looks at it, they'll just go, look, you know, we don't. How would anyone know whether or not it applies to that? So how do you ever decide whether you do anything? And you're seeing that under UK law at the moment. I had a great conversation with some colleagues when I was with Grant Thornton, where we were talking about the application of the GAR. That's the General Anti-Abuse Rule in the UK. And the General Anti-Abuse Rule in the UK can apply, in theory, can apply to anything. It could apply to claiming a relief. It could apply to anything. It's so broadly written. And to try and illustrate the point, I was in a meeting, I was having a conversation with some people, and I said, well, look, I've come up with this thing, and it means that we've got a client, and they will pay 0 tax on their income, and there won't be any tax at all to pay. What's everyone think? Do you think we're probably within the ambit of the GAR? And everyone around the table, well, definitely. If you're getting down to 0 tax, definitely within the GAR, bound to be within the GAR. How could you argue that that's not within the GAR? And I said, well, the thing I'm talking about is they're earning below the personal allowance. So their income for the year is only £10,000, so there's 0 tax on it. Is that within the GAR? Somebody still said yes. At that point I did have a little cry. But the point is the GAR is so, there was a ridiculous comment and it was a ridiculous example. It was intended to illustrate the fact that you can, in theory, apply that rule to anything. If a rule is so broad, it's unenforceable and there's no way a court would enforce it. So I think the general anti-abuse rules under double tax treaties are probably not going to have that much traction. But the limitation of benefit rules mean that what you can do is you can define under a double tax treaty, and we'll see this later on when we have a look at one with the US, you can define exactly who benefits from that particular withholding tax. It doesn't have to be everybody. So, for example, it might just be quoted companies. It might just be companies over a certain size. It might just be companies under a certain size. And you can have limitation of benefit clauses included. And you can also have a specific purpose test. So a principal purpose test, rather. And that is likely to be affecting us. I'll be covering these in the anti-avoidance bit after the break. A principal purpose test says, what was a principal purpose of setting up this arrangement? Was a principal purpose to avoid tax? And if a principal purpose was to avoid tax, then it doesn't work. And that's got much more weight in front of a court, because although there's ambiguity about it, although it's still nebulous to some extent, you know what it's getting at. And you can record the fact that there was a principal purpose in not saving tax, or you can't record the fact that there was a principal purpose in not saving tax. So the limitation of benefit provisions in double tax treaties and the principal purpose test in double tax treaties are likely to be things which will be much more effective in restricting the benefits that we're talking about there. That's it. So we are done. It's time for the break. We've only got a couple of minutes left. So anybody got a question at all on double tax treaties or anything we've been talking about? Yes, go ahead.
Thank you. Back to Article 1 and 2,
yeah.
About permanent establishment. In Article 2 about permanent establishment, you mentioned place of management, and then in Article 1 it talks about effective management and control. So what are the differences between a place of management and effective management and control?
That's a good question, because you can have a place of management without there being effective management and control. So what does a place of management mean? Well, it might be a place where you're managing a particular aspect of the operation of the business. So, for example, let's say you have a group of people who are running around trying to find your customers. Okay, not a permanent establishment, because they're not employees, they're not dependent upon the business that they're working for. This would be our view. Okay, they're not. The business isn't taking risks in respect to them. They either come back and hand us over a customer and get their commission payment, or they don't. But we're not exactly sure they're operating particularly effectively. So we send over John, who is set up in an office over there. And what does John do? He makes sure they clock in every week and gives them directions about where they're going to go. That's a place of management. That's totally different from the effective management and control of the enterprise. That's still happening back in London or back in Luxembourg City or wherever it is where the business decisions are made. Okay?
Okay, thanks.
Anything else? Yes,
I have
madam.
a question on outsourcing services within UN. Sorry. A question in terms of outsourcing services and this UN nation perspective with the consultancies. For example, we have huge IT companies doing outsourcing projects, and some of those last way over 6 months.
Yeah.
Would it mean that they need to set up permanent establishment?
At the moment, probably not, because remember what I put up on the screen there was the UN model treaty. Most people don't follow the UN model treaty. Where you've got the UN model treaty, then there's not necessarily, but there's likely to be a services PE included in the UN model treaty. Okay. What it does indicate is the way the wind is blowing. It's the direction of travel, because that is there. What you tend to find is countries all follow best practice. They follow what's working somewhere else. And it's a bit like the general anti-abuse. Well, it's a bit like the UK copying the disclosure of tax avoidance scheme rules in the US. That was a rule that was introduced in the US. That's a bit like you asking me that. It's a bit like me asking that question 20 years ago. We've heard 15 years ago. We've heard there's a rule about disclosure of tax avoidance schemes in the US. Does that mean we will have to do this? No, not until it happens. But it's an indication. The fact that it's there is probably the way everyone's going to be moving. And but at the moment, most treaties don't contain it. So it does depend on what the treaty contains. If the treaty follows that model, or the treaty just happens to include a services PE, then you'd probably be better just conceding that there is a permanent establishment and setting that up that way and taking the tax consequences accordingly. That's probably right. Okay. Okay, anything else? Anything else? Anything else? Okay, well, thank you for your attention, everybody. We're just over. So I think it's half an hour break now. So if we're back here at 11, then we'll have a great deal of fun talking about anti-avoidance. So have a coffee. See you in a bit.